Okay, so buy-to-lets, we don't touch upon it much on the podcast, and I thought we'd do a significant piece looking at what's going on in the buy-to-let market, because there has been some research that's been published about what's happening in this particular area of investing. So to give you the background, where we are, the private sector landlords has experienced like remarkable amounts of growth over the last sort of 30 years. So we went from 1.7 million landlords in 1989 to 4.6 million roughly currently. Now that's been fueled by lots of different reasons, the legislative changes, flexibility over rents, tenancies. So there has been a number of reasons why buy-to-let was very attractive, and of course we were in a low interest rate period. So I can remember after the financial crisis where people, or just before in fact, where people were jumping on the property ladder trying to buy a house because prices were rising, they'd be able to flip the house or they would become buy-to-let landlords. So there has always been this insistence in the background that buy-to-lets were a good investment. Now, it is a very almost tribal thing, because I get lots of feedback sometimes from people who are buy-to-let landlords if I make a comment about buy-to-lets where they might feel I'm not particularly positive about it, that they'll come out and sort of give me a bit of stick. It's a bit like gold. So you have people who are very enthusiastic about investing in gold. You have that with buy-to-let investing. So first of all, let's talk about yields and rent. So that is what somebody who is going to be a landlord or looking to get into buy-to-let is concerned about. Now, Hamptons have released some research, and it is backward looking. So they looked at 2022 and they saw that rents increased by an average of 6%. And they're predicting or forecasting that we could see an increase of 5% in 2023 and an increase of 4% in 2024. And that's even as house prices flatline or they potentially might fall. But as a landlord, you're really interested in the yield. So that's looking at that rent versus your outgoing, your capital expenditure on that particular property. Now, in the north, there is a gap. So there's a north-south divide. So in the north, typically, you're looking at a yield of about 7.4% versus 5.2% in the south of the country, which is a gap of 2.2%. So that means that there is potentially some interest if you're looking to expand a portfolio or start one, but looking at areas like the Northeast or the Midlands. So you don't obviously have to have a buy-to-let where you live. I think that's a mistake some people make. You've got to look where you're going to get the best return. We're looking at yields in particular areas, and I'm going to just throw some examples. Like I said, you can go and click on the link to find out more. London, you're looking at around about 4.8% in places like Bexley, and if you're going to Barking and Dagenham, then you're going to get about 5.12%. But if you go to the Northeast, so we're looking at places like Sunderland, Middlesbrough, you're going to get about 7.61% yield, so it's much more attractive. As I say, you can find out more information by clicking on the link in the notes. So we've done the rents, we've done the yields. What's going on in the market? So for landlords at the moment, what are they finding? Now, there have been quite a few setbacks in recent years for landlords. Now, the first one is that there was a phasing out of the tax relief that landlords could enjoy on their mortgage interest costs. So that hit their profit margins, and that phasing out happened up until April 2021. So previously, landlords were able to deduct the full amount of mortgage interest payments from taxable income, reducing their overall tax liability. So that changed. Then we also saw things like stamp duty increases come in, so there were additional rates of stamp duty. We've also seen changes to capital gains tax, which we covered on this podcast, from April this year, which increases the tax liability if you're going to sell a property. And then we've also had the impact of rising interest rates, which I'm going to go on to now. So you've seen the taxation point of view. For landlords, it's become less attractive because it's become less profitable, but now they've been hit by rising interest rates. So buy-to-let mortgage rates have nearly doubled since March 2022, and that's put significant pressure on landlords. Now, 2 and 5 year mortgage rates are on average 6.03% compared to 3.05% and 3.29% this time last year. So you can see that's a big jump. And we've had several lenders, I mean, I'm not going to name them because this is changing all the time, that have either increased their rates in recent weeks or they've pulled their products altogether. Now, I've given average rates. Just to be positive, there are lower rates out there. The best rates you're going to get is about 4.9%. So those rising costs are having a material impact on the profitability of buy-to-lets. Now, Savills give an example of a buy-to-let investor with a 70% loan-to-value paying income tax at a higher rate. Now, last year, this investor would have made an average profit of 23% of their rental income, even after tax. However, the figure has now plummeted to just 3.9%. So that is a huge difference, and it's because of this double whammy of taxation changes and, of course, the increased cost of borrowing. This is the side of property that people don't really talk about, and it's leveraging. So buying property, people say, oh, it's safe as houses. The thing with property is that it's all about leverage a lot of the time when people make money. So you're borrowing money to buy assets where the price historically has steadily increased by around about 3% per year. But the reason that it often gives people outsized gains and they can make a lot of money is because of leverage. And so it amplifies your profits, but it can also amplify your losses, which is what people are finding now. And even people personally are finding that situation where they are finding their mortgage payments on their residential homes jumping. So on top of those headwinds, you've also got future changes in regulation that are coming in. So one of those is the potential for a minimum standard of energy efficiency in rental properties, but also we've had the Renters Reform Bill. So we're having changes being made to legislation that will change landlords' rights. And one of those things is it's going to be changing something called Section 21. Now, previously, landlords could evict people without reason, but that's going to change. It's going to make it a little bit more difficult for landlords. We're not going to go into it on this podcast. So that will put off people who potentially might want to become landlords, but also existing landlords. So what does it mean for the market? Well, we've seen landlords start to exit the market, and when you look at the numbers, there was a piece of research that showed that the number of available rental homes had fallen by 40% over a 3-year period, and this research was done just over a year ago. So we're seeing the buy-to-let market technically start to shrink, which is obviously a problem for renters because it means there is less supply of properties, but the demand for rental is still there, which is pushing up rents even higher. But for landlords, it's still often, with the increased rates that are going on, mortgage rates, it still might not be profitable enough for them. Now, there are things that people do where they try and hold properties via limited companies. I mean, we're not going to go into details on that. The other issue that we've got in the market, there are a lot of landlords that are getting to their own retirement ages. So currently there are nearly 2 million buy-to-let properties owned by landlords over 65. And there's an additional almost 2 million properties owned by those aged between 55 and 64. Now, if that demographic decide they want to start to sell because obviously they get into an age where they might not want to be engaged in buy-to-let, then that could cause more problems in the market, but also particularly for renters, because it will mean that there could be a shortage of properties that they might be able to rent. But also, there is also a concern that we're going to see landlords shift to only wanting to rent to people who are financially stable. So people on lower incomes might find it more difficult to find properties because of the changes to legislation and obviously landlords trying to make as much profit as they can and not being able to survive if they have periods where they can't guarantee they're going to get rent. So what does this all mean then? Buy-to-let landlords are at the moment feeling the squeeze. There's been changes to taxation, which is obviously driven by the government's agenda. There's also been things like interest rates going up, which is having a big impact on buy-to-let landlords. Don't forget, people have built buy-to-let empires based upon leverage, so borrowed money, and that cost of borrowed money is increasing rapidly, so some of those are becoming forced sellers as it starts to come down. I know most landlords only tend to have an additional property, just one property, and the other thing is that rent increases based upon some of the research are starting to slow a little bit, and the yields aren't as generous perhaps as they were before. So you're going to have to do your homework. So if you do your homework, of course, you can probably make buy-to-let work. So looking forward, buy-to-let can work, but it's likely to work for those who are either cash buyers or who have low borrowing, so they haven't leveraged a lot, but had to borrow a lot of money to be landlords. That looks like where the market is going. So if you do your homework, then of course you can probably make money, but it is not easy. That's the point. I think some people think anybody can be a landlord, and I think that's doing a slight discredit to those out there who do it successfully, because there are problems. And what we're seeing at the moment are those problems coming home to roost.
Do you think also the uncertainty with house prices at the moment might be causing uncertainty amongst potential landlords?
Yeah, I think that's the case. And of course, you've got to think about not just the landlords themselves wondering whether they are going to get into being a landlord, because you could obviously have a fall in the value of the property if you decide that you want to sell it. But also, I think when you're going to get lenders who are assessing landlords and for mortgages, then they're going to obviously be building in at margin of error for potential pullback in house prices and also rent. So we mentioned a while ago on the podcast that the lenders are already raising their bar when they're looking at underwriting any mortgages. So it probably as easy to get a mortgage, not only because the products are being pulled, but because lenders are going to be looking at these things probably that little bit more closely.